Hey everyone. Just FYI, I'm still kind of I don't sound that great still. I also have some more research on this that I'd like to into at some point, but I wanted to put something out there just because I said I was going to on this year. Last year was wild. The bonds being down over 20%, the S&P being down about almost 20%. It was a messy, messy year. And fortunately, Q1 was great, which ended up giving some um, padding to the year, which was nice, but the rest of the year was very, very tough. And I don't think there wasn't many people who escaped the year without having a tough year. 95% of hedge funds had a down year. And now talking about down as in, 0.1% down, some of them down 10, 20, 30, 40. A lot of people went out of business. Very messy year last year, but it was risk control wise and basically, the number one rule, which is what I put this quote up there a lot in these just because it's kind of the overarching narrative. As much as sometimes I want to really put the hammer down on certain situations and send things and then I'm seeing it's always rule number one is the key to building wealth is to preserve capital and wait patiently for the right opportunity to make extraordinary gains. Um, so sometimes you you will give back profits, you will have bad periods and so on, but as long as you're not wiped to zero, as long as you have a good capital base to come back to, for me, I'm always looking at the year to date. What's the year to date? Are we, if you get, I had a friend who we had a conversation. He was talking about being, down 5 or 10% year to date, and I was like, well, if you were looking at yourself 2 years ago and you were in that same position, would you be, destroyed about that? And no is the answer. So getting to start over a year close to where you were is not a bad thing. And not to mention, there's always going to be more opportunities that are going to come. So looking at this now, I think, 2023 could be an interesting year, not because I think it's going to be the most bullish year, not because I think it's going to be perfect, because I think that as things come up, a year like last year usually leads to um, different moves. And so most of the time when you have a down year in general, the next year is usually an up year. Most of the time, probabilities of that is pretty high. Sometimes you can have down years back to back. That does happen. But most of the time, that's what you're going to see. Either a very choppy year where we're not going to move much, or an up year. So I would be ready for each scenario, trying to be in the strongest sectors possible. And we'll see where we go from there. But to me, I could see the beginning of this year being interesting, more bullish than bearish, mainly dependent on the Fed. I could see the Fed getting a little bit behind the curve and then needing to step back. Because for me, I really think, everybody is looking at cuts, and cuts don't have to happen in this type of environment for inflation to get out of control again. Now, granted, I'm not talking about tech. I'm not talking about the S&P 500 itself right now. I'm talking about inflation, inflationary assets, and so on. That doesn't mean, their inflation could be falling and commodities could be bottoming at the same time. That's very possible. And I could even see a very interesting stagflationary environment where bonds are actually moving higher with some of these commodities. The commodities I'd be looking at the most right now aren't the same ones that have been moving. I'd be looking more gold, platinum, silver, and these precious metals absolutely would be the ones to benefit from yields finally coming down and the curve already being inverted. Usually, most of the time when the curve inverts and then flips and goes the other direction, that's when you see things like precious metals and so on moving higher. But right now we're going to talk about equities a little bit. I borrowed some stuff from Larry Williams here. I didn't want to step on his toes too much, so I only grabbed the ones that weren't because I pay for one of his products, but here I don't really want to steal all his stuff that was all him, but things like this, like these are charts that anybody can build. They're pretty simple. I could build them on my own, but since I'm only sharing them here, I'm just sharing them with you guys. The average all 3rd years in office. Now this is to go move with the presidential cycle. Now there's lots of theories if you want to Google and learn about the presidential cycle and why, midterm years are like this and why 3rd years look like this and why election years, tend to bottom in November, go read about it. But basically kind of looking at it, what we do is we take all the years from 1975 forward and we go, okay, well, most of the years this looks like this. So all 3rd years in office, 1939, 1971, and then 1975 forward is in red. And so in red, we're kind of seeing that, okay, it does look pretty bullish. Now, once again, cycles aren't a thing that we're going to look at and go, okay, well, this is going to be, I'm going to buy and, hold relentlessly till here and sell here and buy here. Most of the time it's trying to tell you where a top and a bottom, bottoms tend to happen. So let's say here's a top. Let's say there's a bottom. Let's say here's a top, there's a bottom, and once again, we're not trading on these cycles. This is kind of our roadmap. I always say when the land of the blind, the one-eyed man is king. This kind of sums that up, which is understanding where we could be going. And most years, this is pretty a normal pattern. Basically sell in May and go away is actually very true, where you have a lot of bullishness in through April, choppy summer, market bottoms in October, and then you usually get a rally to year end. Granted, it doesn't happen like that every single year, but that can happen. But this is the average of all 3rd years in office. And if you looked at 2nd years, it looks very much like last year's picture, bottoms and top wise. All years ending in 3, you guys have seen me look at this cycle before. So here we go. We got a bottom here and end of February, top here and somewhere in March, another bottom in early April. So basically if you look at this detrended, we're seeing that this is what we're talking about top, this is what we're talking about a bottom, top, bottom, top, bottom. Now this doesn't mean that it's going to go up and down and up and down, and this has nothing to do with magnitude. This could be an uptrend, and this could be a bottom, a temporary bottom, temporary bottom. This could be a downtrend. This could be a temporary top, temporary top. There's many ways of looking at this. So basically to me, it's something to go, okay, this is where we could see some bottoms, this is where we could see some tops, and that's all we need to look at from there. 1978 highlighted. So this is the S&P 500. If we're looking at the S&P 500 all the way out here, in 1978, we look at a very kind of similar picture to the yield curve. And so when we're looking at the yield curve, we're going, okay, well, this kind of looks similar. This now, once again, this is a theory. This is not something that I'm going, okay, I'm going to trade on based on this. This is kind of looking at this. We kind of look like we're in a similar area. And I like to look at history to kind of understand, once again, roadmap. That doesn't mean that my buy signals and sell signals are based on this. This is kind of just a thought on looking at the general market. When I'm looking at it, we're in a very similar situation, inflation-wise, GDP-wise, stagflation-wise, the Fed raising rates, and so on, to see that we're very in a similar spot to 1978 here. So it wouldn't surprise me to see the Fed get a little bit behind the curve here. I wouldn't be very surprised at all to see the Fed get a little bit behind the curve, and possibly inflation get a little bit more out of control again, and see another little bump in inflation again before we see really the big inflationary sell-off. Basically, the run to bonds, the run to dollars, and so on. Right now, I could see that this possible that the dollar starts to come down here, and commodities start to move up again, and possibly see one more run in these things. Next is the S&P 500 against the Dow Jones World. World Index is an interesting one because we basically haven't seen any reversal in this in a long time. Now the world indices used to do very well at certain periods. Obviously, the U.S. has been dominant in that, but at certain periods they have outperformed, and they haven't for a very long time. It would be interesting to see that happen again. This thing's kind of coming down pretty hard right here. It's below the 200. Something to keep an eye on. Nothing that I'm going, okay, well, I need to get out of all U.S. stocks or something about, or I need to warn everybody. And none of that's in my head at all. But just looking at it, keeping an eye on it, and going, it would be a place to kind of look for some of these interesting areas that you might want to look at in the world. Now, I talked about in the last couple things I put out, I did put out one in October about October bottoms. We definitely saw a bottom in October. Was that the bottom? I'm not sure. It really chopped. It came right in at the end of the year, which was tough for a lot of people to deal with. I think it created a lot of panic selling because everybody's already, a lot of traders are already in kind of a bad place by the end of that year. Not to mention with all tax loss selling and so on, there's a lot of people with down years. So because of all that, I think we saw a bit more selling in December than we usually do. But one thing that's very interesting is that we saw a major panic here, a lot of call buying, or sorry, a lot of put buying. And as we saw a lot of put buying, we saw that culminate in this area. No, that wasn't even the low. That was just after the low. So that's kind of an interesting one, which I do like seeing that kind of strength with extreme panic. That kind of seemed to tell me a lot. We see one of those in this area. That was that big rally through 2017. But most of the time, this kind of puts in a temporary bottom. That's bottom for 2015, a bottom in late 2016, 2017, bottom in 2018, bottom in 2020, possibly a bottom that was in December. Once again, it's cautious here. We're not going, okay, it's definitely a bottom, let's buy everything. It's a be cautious, be tactical. Telling myself that just as much as anybody else. Bull bear indicator. Now this is actually in bullish range. This hasn't been in bullish range in a long time. It's gotten back into neutral. We did see some bullish spikes in the 50. This is stocks above the 50-day in the NYSE, and stocks above the 200-day in the NYSE. So right there, we're seeing that we're definitely in a bullish zone. So breadth is starting to turn up. That's a really good sign for the broad market in general. The S&P against the equal weight S&P. So that's the S&P 500 against the equal weight S&P, which is the RSP ETF. It does have a little bit more strength than the S&P 500, which says that the rally is a little bit more broad than the S&P 500. Or sorry, the rally is more broad. Sorry, like I said, I'm not feeling too great, so just bear with me on this. The rally is a little bit more broad than usual. That's a good sign. That means breadth is a little bit better than most people think it is. Copper, buy on all time frames now, so that looks really good. Copper is turning around. It looks like it could have bottomed. That would be also a good sign for the global economy as well. Bonds or energy commodities. So this is the CRB index against bonds. CRB has been leading since the bottom in 2020, but it's starting to possibly top out. Now, I'm not sure if this tops out here. We're still holding in the bullish zone. This could be just it, and it could go higher, but I wouldn't be surprised. But this chart is going to tell me a lot. We start to break down bonds, even though I do like the 30-year bond. We had to talk about that in one of the last videos. I wouldn't be surprised to see bonds start to really outperform if that happens, or if this goes to the upside. I wouldn't be surprised to see oil start to move higher again, back to that 100 zone. Junk bonds here looks really constructive. Honestly, I wouldn't. That's another thing to be bullish on. This looks very constructive. If we get a couple more days up in this, and we get to see this kind of get above this range, I'd be more bullish on the broad market. The yield curve, yield curve still looking fucking disgusting. But not too bad. It's just a point where it's either going to move the other way, start to invert the other direction, we see a rally. But either way, this is a warning sign, guys. And I think we have to really keep that in mind, that I could see that move the other way and move higher, but I would still be ready for 6 months to a year from now for something, some type of black swan to happen. So that's telling us a lot at the moment. Here's the yield curve as well. Looking at this, we're starting to the 30 years start to try to get back to the upside. We most of the time when we see a healthy market, the 30 years up here, most of the time we see these very wide, that the yield is very spread out. Right now, everything's really tight. It's starting to try to spread out, but it's still inverted. Nothing really good there. Here's sectors. Maybe I need to look at it this way. So energy, this over the last 6 months, energy is still leading. XLI, next, XLB, and XLF. I still like these. If you are interested in the equities, I still would like those sectors above all the other sectors for lots of reasons, regime wise, value wise, and price action wise and relative strength, obviously. So all of these sectors do look better than most of the sectors. I would still be interested in those sectors out of any of them. The S&P 500, like I said, we're getting buy signals. It's a cautious one though. I wouldn't just run into it and hold it. I would be waiting for specific buy signals to happen in all of these to get into some new positions. Here's the dollar. The dollar obviously broke down in this zone, came down, 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 broke to the upside, ran really hard in 2021. Now it's breaking down again. And most of the time, this is why I'm saying I'm not sure about what the Fed is going to do with yields, because the market is now telling us something that they're going to slow down. Not saying that everybody's looking for cuts, everybody's looking for this and that. I'm saying that I think they're going to start to slow down. I think the dollar is also on board with that. I think bonds are also on board with that. If I'm looking at both of these and they're both saying the same thing, I want to be on the side of the price action and what people are actually doing compared to what people are saying. Here's gold. As I mentioned, gold is really, really moving nicely. I really would be very interested in gold, silver, platinum over most of the other things in the market. Here's soybeans. Ags actually are starting to look very good as well. There's a lot of reasons for that. COT data is also pointing to most of these ags looking for more upside coming into play. So I keep an eye on those. The Mexican peso is definitely the best looking currency, which I don't think I've ever said that. The Mexican peso is definitely the best looking currency in the market right now. It's definitely strong. It's been strong. Look at the relative strength coming here. At the end of 2021, started to have some major relative strength compared to everything else in the market, currencies, commodities, equities, and so on. So it's starting to show major relative strength. It's breaking out to the upside. If once we get over that high, there's not really much over that for a while. So I'd be very interested in the Mexican peso. If you are a currency trader. Bitcoin, I think that's where we end off. Yep. So Bitcoin is holding above its 200. It's also the thing that's going to tell me if there is a lot of interest in a risk on environment in the market. I would say that Bitcoin's certainly looking like the market's saying risk on. We have some liquidity somewhere, and liquidity is going to come back into play soon. So I'd be really, really watching Bitcoin more than anything. It's not that you have to trade it. It's not that you have to buy it. I would just really watch it. See how it holds up. Is it going to hold over this 200? If you are a trader and you do want to put a trade on, something with a close stop under that 200, wouldn't be a bad idea. and just hoping that it holds above it. Now we have a few closes above it. I've talked about it before. The probability of it being a winning trade when it's holding above the 200 for 3 days goes up. So volume is really flowing into it. There's a lot of buyers, a lot of really bad sentiment, and news is as bad as it gets. So if news can be this bad and the market is moving higher in Bitcoin, I would be more bullish than bearish on the moment, but everything's very cautious at the moment. Things can go two directions. This could all rally and everything could be crazy, and the Fed could go, well, we fucked up. Like we need to go back the other direction. So, it's time to be cautious over everything. But I do like the probabilities of the market and all these other things moving to the upside. All right, guys, I hope you had a good one. I'm gonna post this now, and then we'll talk soon. I'll hope to get to some more of that stuff that I've been looking at over the last month, in the next couple weeks. Hopefully, I can get that posted, and I'll talk to you guys soon. Thanks for bearing with me and my fucked up voice.